Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, we'll be talking about the big picture with one of my favorite market analysts, Wayne Kaufman, who is the Chief Market Analyst at Phoenix Financial. Wayne, always great to have you.
Great to be here.
I love having you on because we get to talk big picture, and boy, there has been a lot of big picture lately. We've seen some crazy gyrations in gold, in the dollar, in oil, even in stocks. Why don't you kind of summarize right now how you think, it sort of looks to you?
Well, in terms of U.S. equities, we've been watching a deterioration of market breadth, underlying market breadth that hasn't shown up or had not shown up in the major indexes until the last couple of weeks. But for the last 3 or 4 months, we've been watching small caps get decimated. And then the mid caps followed. And then the large caps, S&P 500, had a peak recently, but the breadth was terrible. And now the stocks have rolled over. And it's to the point where you've only got about 18% of S&P 1500 stocks over their own 50-day moving average, less than 1 in 5, and about 1 in 3 that are still over their 200-day moving average. So that underlying deterioration came through and pulled down the major.
Now, with small stocks weak like that, wouldn't that suggest general economic weakness, or at least a tip-off to that effect, that we're seeing, basically small, medium-sized businesses not doing very well?
Definitely. You're right, of course. And there's, you're talking about changes taking place. It's the question in the mind of investors right now is we're seeing the weakness in China, the weakness in Europe, Germany all of a sudden rolling over. You've got the price of oil. It's all of these things that are turning dramatically. And the question is this a long-term trend change, or is this just going to be short-term? Is it just typical October stuff in the case of equities? And that's what we're going to find out over the next few weeks.
Now, we've seen it manifest also in a lot of commodities, industrial commodities in particular, and recently very sharp declines in oil prices. The question I have is, financial markets have been very tuned into the movements of central banks, low interest rates. That has been a prop. That has been a support for financial markets, at least for equities. Is there really a downside when people know the central banks are going to be there, push comes to shove?
There, at a point, is only going to be so much that the central banks can do. So
it's pushing on a string.
I was recently asked by a news outlet to give my projections for, the S&P and what my reasoning was. And my number one reason for being bullish was central banks around the world will do everything possible to prevent a global recession. So now the question is, are they really able to do much more? That's going to be a big issue. We know they're going to try. The question is, are they going to wait too long before they actually try, and how effective they can be?
And I think, you make a very good point that there's a lot of evidence that low interest rates, even 0% interest rates, is not having the effect on aggregate demand and employment that they thought. It's been a buoy for financial markets, at least, in some sectors, stocks, equities. But in terms of the real economy, we see that dichotomy between low interest rates and still kind of tepid demand. And in fact, weakness of recession in Europe, as you mentioned. I want to talk about gold, because I know the last time you were here, you were negative on gold, and that play worked out pretty well. How do you see things panning out from this point?
I see short-term oversold and over-bearish sentiment. So a bounce is definitely in the cards, especially if there's some short covering by people who are short the futures. But when I was here last time, I said I couldn't get bullish unless gold broke 1,400 or so. Now that number's a little lower. At the very
Where is it?
13. I need to see 1350 at least, because you do have a potential triple bottom. I see a lot of people say, oh, triple bottom, triple bottom. It's a potential triple bottom that doesn't get confirmed until you break an important resistance. So unless we can get above 1350, I'm not even going to start thinking about getting bullish, except for oversold, over bearish bounces.
Well, that's not that far away, which would suggest that the market is really kind of, heavy. I mean, sort of not having that potential to rise very much. And let me ask you, even given we see a lot of negative sentiment towards gold now. I mean, I had a guest on here recently, and I mentioned the fact that we see headlines very negative, very bearish. Recently, in a widely followed financial blog, talking about the death of gold. Reminds me of the death of equities, right? Back in the infamous Business Week cover of 1979. What do you make of that?
Well, I agree with you. That's why I'm saying I could see a bounce here, because it's oversold and it's over pessimistic. Levels of pessimism are extreme. And when you see that, that's a good time to take the other side of that trade. The question is, how much staying power? You're talking about commodities going down. The dollar's been strong, which is a little too much bullishness in the dollar, so that certainly can be capped here. But oil is just amazing. And for years, you always said that the Saudis controlled the price of oil. You were 100% right, because of course they're the only country that really has
excess capacity,
significant excess capacity. Well, right now, are the Saudis purposely trying to drive the price of oil down so that they can try and put a cap on fracking and energy exploration and production here in the States?
Shale guys, the shale producers.
Potentially an amazing tactical war going on between the Saudis and the United States in terms of oil production.
And if that happens, I mean, and I saw an example of that back in the 80s when I was an oil trader on the floor of this very exchange here when they crashed the price down. And that was a message that was sent to the non-OPEC producers, the North Sea guys in particular. So, yeah, I think you're absolutely right. That's going to be interesting to see how that plays out. And I think, you mentioned the dollar. That was a surprise to most people because we had this narrative for a long time about money printing, right, and central banks and quantitative easing and hyperinflation and the Fed doing all this. Yet, look at the dollar.
It's your show, and I don't want it to seem like I'm complimenting you because you're the host, but you said this a long
time ago. Don't hold back.
You said a long time ago, all the inflation guys, that they were wrong, they were going to be wrong. You were 100% right on. You said this a long time ago, too. So it was a big surprise. Now, as a technician, I called the dollar going up at a point when I saw it giving me buy signals. I don't do it the intuitive or the economist way. And now it's hugely overbought, and it's extremely over bullish. It has been taking a pause. I think it'll continue to pause here. It's just too many people on that side of the trade at this point.
And not only that, I mean, we heard comments recently from New York Fed President William Dudley to the effect that, hey, a dollar that's too strong might hinder our ability to achieve our goals. Hint, hint, a little bit of a, code words there for saying we don't want the dollar too strong because it tends to be deflationary. It would hurt profits of U.S. corporations, that sort of thing. So it sounds like they're sort of giving a hint that that's about as far as it's going to go.
You're right, but the problem they have is, the strong dollar is going to hurt exports, obviously, but you've got S&P 500 companies do, in the neighborhood of 40% of revenues, 50% of profits overseas. So whether it's from the strong dollar or just because the economies overseas are very weak right now, either way, no matter how you go on that, it's going to be a problem, and the world economy needs to clear up. Or there's no way that we're not an island unto ourselves. It will affect us, and I think that's what equities are starting to show.
Good points. Wayne, always great to have you here. Thanks very much.
You're very welcome.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.